Hey there, Matt the Mortgage Guy. I'm going to record a quick video today, talk about Biden's housing plan. Pros, the cons, my take, what I think about it as a mortgage professional, as a real estate investor, and what I think, may or may not come of it. So before I get into it, if you like straightforward, honest advice about mortgage, real estate, finance, things like this that relate to real estate and finance, go ahead and smash the like button. Looks like this. Smash it for the YouTube algorithm. Consider subscribing. Thanks. Let's get into it. So Biden has a housing plan, and as president-elect, first and foremost, I want to say this video is not going to be political. And if you want to make it political, you can miss me with all that stuff. I'm just talking about what I think may or may not happen, how it's going to relate to housing and the clients that I serve, the pros, the cons, what I think, hopefully comes of it in the next 4 years. So with that, let's jump in. I've got it saved to a Word document. It's a 16-page housing plan. And investing in our communities through housing. It's a $640 billion plan, and that's over the next 10 years. It's got a bunch of cool stuff in here. And again, I don't want to make this political. Politicians in general, and this isn't left or right, this is all of them, make promises sometimes that aren't kept, or it sounds really good, doesn't come to fruition. So with that being said, this is the proposal, this is the plan. Let's hope that some of this stuff comes to fruition. $640 billion over the next 10 years, bunch of great ideas. I went through here and highlighted some stuff that I thought was important. And I'll give you my take as somebody who's in the mortgage industry, who deals with a bunch of clients, who sees this stuff from the inside. So the first thing I highlighted, it talks about communities of color are disproportionately impacted by the failures in our housing markets. And the stats show home ownership rates for Blacks and Latinos is way below the national average. And because of that, that adds to the wealth gap. And I'll show you something. I've got a past video I made that talked about the net worth if you're a homeowner versus a renter, and different stats in different places say different stuff. On this one, the average homeowner has a net worth of $195,000, and the average renter has a net worth of $5,400. So it says 36 times. Other places say it's 40 times greater. And if that doesn't make sense to you, when you own a house, you're paying your mortgage every single month. It's appreciating in value over time. What you owe on that mortgage is going down over time. So even if you're a working man, not making a ton of money, not saving anything, you're increasing your net worth. And when you're 60 years old and the house is worth $400,000, you only owe 36, or you've got it paid off, that's net worth. And by being a renter for life, you don't get to see that. And so what this portion of the plan was talking about is that is hurting Blacks and Latinos who have, statistically, their home ownership rate is lower. And so it's contributing to this wealth gap. $640 billion over 10 years, already talked about that. Some things he talks about in here, like redlining and increasing supply, I'm going to get into it, give my opinion. Ending redlining and other discriminatory unfair practices. As a mortgage lender, I can tell you a few things, and I can tackle this from both sides. And I'm not going to try to be biased and say that all mortgage companies are super ethical and every lender in the world, is the most ethical person. But by and large, most lenders out there are writing loans for as many people as possible. Remember that mortgage folks are commission based, so they're not trying to turn people down. They're trying to qualify as many people as possible, get people to the closing table as often as possible. So I think that, redlining is a lot less common. And redlining is where, you're discriminating against a certain part of town or a certain ethnic group and denying those loans at a different rate than you would deny loans in a different part of town. So while I think that has substantially subsided since 2008 and the crash and all these regulations come in place, what I'll tell you is I was looking up reverse redlining. And reverse redlining, I don't know if I can find the article anymore. I think that is probably something that is more common, where you're putting more people in these low income areas into, I won't even call them bad loans, but they're being pushed products that may or may not benefit them. And I don't really want to get into it in this video, but down payment assistance is something that, through my eyes, is really pushed on Black and Latino communities, when long term, for the most part, a lot of programs I see are really bad long-term investments. When you're giving somebody a payday loan for all intents and purposes, and they're borrowing 105% of the home's value to get into a house, that's reverse redlining, where you're putting them in a product that's setting them up to fail. I'll get passionate if I talk more about that, so I better just pump the brakes on that. Increasing the supply, lowering the cost, and improving the quality of housing. Now, regardless of left, right, center, where you stand politically, when somebody writes this, I'm going to say, it's a great idea. How in the heck are you going to do that? Energy efficient homes. And then you think that's going to lower the cost? I mean, this is a big dream and a big ask, because increasing the supply is by far the biggest need in housing in 2020, 2021, 2022. There's not enough supply. Homes are expensive, and they're harder and harder for people to obtain because there's a lot of demand. Rates are super low. There's just not enough supply. Historically low levels of supply, houses on the market is what I mean by supply. And so that's why 15 bids per house, and the house that's listed at $395 sells for $430, because there's so much competition for so few houses. So if you've got a magic pill, if you can show me, government, how you're going to increase the supply and lower the cost and make this stuff happen, I am all for it. Please. Because here in California, where I'm at, when you talk about lowering the cost of building, not only the materials have got more expensive, but all the regulations and all the stuff you have to pay, permits and city, it's almost impossible to build affordable housing. And so when there's lack of housing in the affordable neighborhoods where it's needed the most, it's a lot to do with all these hoops you got to jump through, all these permits you have to pay, all these city fees you have to pay. And so that's where it starts. If I'm on this board and I'm talking to people about what to do to increase the supply, lower the cost, help out the housing market, I'm going to give humongous grants to people that want to build the housing that's really needed for the people that really need it. And, maybe you do it where, this housing is only available to people that make less than $80,000 per year. And this housing is going to be at a certain rate, and this builder has to build it and sell it at a certain price so these people can afford it, but they're going to get a grant from the government that's going to offset their cost, offset this ridiculous amount of permits and such. Man, I could just rant on this stuff all day. Hold financial institutions accountable for discriminatory practices. A lot of this has really come a long way in the last 12 years. If anybody who's listening to this knows how mortgages were written 2005 through 2008, you know that there is a ton of legislation, a ton of stuff that's passed that's really protected all borrowers across the board and held financial institutions accountable for writing bad loans. And the discriminatory stuff, from what I've seen, it's that reverse redlining I'm talking about, where you're not necessarily turning people down, but you're promoting and targeting people in certain neighborhoods with really bad products. So next thing, that I highlighted because I think it's relevant to me and my area of expertise. Strengthen and expand the Community Reinvestment Act to ensure that our nation's bank and non-bank financial services institutions are serving all communities. Now, this one's interesting because in here it talks about Fintechs, and Fintechs is a financial technology company in the mortgage industry. More and more of these companies are coming out. And what this is talking about, what this says to me is if you're going to be a fintech, you've got to serve everybody. You can't just come into the mortgage space with a financial technology company. I think a lot of these are based in Arizona. And I've seen it. You know, they've got advertisements on TV where a 30-year fixed 2.25%. In the small print, you got to have a 900 credit score. You've got to owe 25% of what the house is worth. But that's super small parameters on loans they'll actually do. That's discriminatory in my mind, because, you know, the $300,000 loan on the $1 million house, if you're just doing those loans, what about everybody else? You're not serving, you know, 90%. You're not serving 95% of the folks that are out there. And so if you're going to come into the mortgage space, you got to come into the mortgage space with the idea of serving, you know, as many people as possible. And you can never serve everybody because there's going to be rules in place, because the lower the credit score, the riskier the borrow, and you have to price things accordingly. That makes sense. And that's not necessarily, you know, redlining or discrimination when a mortgage company says, here's how we price loans for credit scores between 600 and 640. Here's how we price between 640 and 680. That's just pricing accordingly available to risk. You can't do it based on color or anything like that. So that's that. Here's one, and this is probably the one that got the most attention, is a $15,000 tax credit. And, you know, before he's even in office and before they've even talked about it, we don't know if this is going to go into effect 2021, 2022, 2023, or may not ever get passed or ever go into effect. But the $15,000 tax credit is a cool thing for first-time buyers, cooler than that $8,000 Obama one, mostly because they say it's going to be advanceable. If you remember back when there was an $8,000 tax credit while Obama was president, it was you buy a house, you're a first-time buyer, you go file your taxes, you get an $8,000 tax credit. Thanks for buying a house. Thanks for stimulating the economy and the housing that needed it. This one, advanceable, meaning that's going to be towards your down payment. Like at the closing table, you're going to get that $15,000 credit. Now that would be cool. Here's the caveat. Right now, where we stand and where we're likely going to stand the Q1 of next year, Q2 of next year, we have far too much demand and far too little inventory. We cannot implement something like that without it being hugely detrimental to everybody. Because here's a quick example to kind of illustrate for you. Right now, you're a first-time buyer and interest rates are super low and you're super stoked. And you can get, you know, I won't quote rates because it's not kosher to do that as a mortgage person. But let's say that you qualify for up to a $350,000 purchase and you're excited. Now you can get a $15,000 credit. So the amount you got to bring out of pocket is even less. You go out and start looking at houses that were $350,000 as of October 2020. Now it's January of 21 or February of 2021. This $15,000 incentive just brought a whole new flood of demand, new buyers. That house gets bid up to $380,000. So you got a $15,000 credit, but you paid $30,000 more. Or maybe it gets bid up to $390,000. That's what it's going to do. It's going to jack prices up. So this would, in my opinion, be a really good idea if we saw some sort of leveling out, some sort of downturn, you know, folks who couldn't get back to work, lost their houses, and there was a bunch of inventory on the market and things slowed down. All right, 2023, let's slap this thing in. Let's get some of these folks that we talked about who are underrepresented or have a low rate of home ownership. Let's get them in a house. Let's give them a $15,000 tax credit. I highlighted this one too because I believe in Section 8. As a real estate investor who has Section 8 tenants who have taken good care of the properties and respected properties that I've owned and paid rent on time, it's a good idea. For people who don't know what Section 8 is, if you're low income and you need housing assistance and you qualify for Section 8, you basically go find a rental and the housing authority is going to pay a percentage of your rent. So I've got properties where, rent is $850 and the housing authority pays $750. So you only have to pay $100 of it. And for folks that really need it, it's important. As landlords, you know that these people have to follow certain rules to be able to continue to get the voucher. So you just tell them, take care of the property and you'll continue to get the voucher and have a safe, clean place to live. Everyone wins. And so what this is talking about is that 3 out of 4 people that are eligible for the rental assistance don't receive housing assistance because the program's underfunded. And I think that it's, you're on a waiting list for 5 or 6 years and there's just not enough housing, or the infrastructure is not there to get these people into the housing they need. And this is kind of a neat idea too, is a renter's tax credit to help low income families, because this makes a lot of sense to me because living in California where rents have gone bonkers, certain people live in a certain area because they have a job. But if that area has seen rent increase after rent increase after rent increase to where their rent went from $1,300 to $1,800, but they're only making $5,000 a month, that's a humongous increase for somebody like that. So this bill, the way I read it, or this renter's tax credit would say, hey, we don't want this guy paying more than 30% of his or her rent, his or her income towards rent. So the rent went up to $1,800. He makes $5,000 a month. She makes $5,000 a month. Let's give him a $300 a month supplement for that rent. Landlord gets paid. Renter, has 30% of their income going to rent and no more. Sounds like a good idea to me. All right. I think this is probably the last thing I got some more stuff in here. Increase the supply, lower the cost. Throwing money at it certainly helps, but you got to have a really, really good plan to increase the housing supply. It's not going to happen. Why am I not showing up on here? Technology is hard. Okay, $5 billion. $5 billion is like a drop in the bucket, dude. How are you going to increase the stock of affordable housing? It's really going to take incentivizing builders, incentivizing people who are building housing and whatnot to the tune of hundreds of billions to really increase the stock of affordable housing. And we need it. Trust me. I'm all for anything that would help create more housing. And I might have a distorted view because I'm in California, but when I know how low of inventory we have and how hard it is for somebody entry level, 300,000, 350,000 to get into housing, it frustrates me to no end that they continue to build $500,000, $600,000, $700,000, $800,000 houses. And I understand why though, because as a builder, you can't build a $350,000 house. California charges you too much. The cities you build in charge you too much. The cost of lumber has gone up too much. And so in order to get those houses built, governments have to say, you know what? I know that you could never turn a profit by building in this neighborhood at this price point. So guess what? I'm going to pay you X number of dollars per unit. Build them and sell them at that price. I don't know. I'm just a mortgage guy, not tax incentives for the construction of more affordable housing in communities that need it most. That's what I just said. All right, these guys are listening. They're listening. Dramatically increasing the number of new or rehabilitated affordable housing units. That's what we need. I'm all for all this stuff. This is what we need. Okay, expand funding for mission-driven, community-based financial institutions that invest in building new housing in underserved areas. New affordable housing. I hope we get this stuff done. The next 4 years, 8 years, 12 years, whatever it takes. I hope that nationwide, in my beautiful state of California, we won't start talking about California. All right, that's it. I hope you enjoyed. I had a housing inventory chart here somewhere, just so you can see when we talk about housing inventory being like historically low. This is months of supply. 12 months of supply. There's a year's worth of houses for sale at, was that 2009? And here's what I look at, and I think to myself, this is what's a little bit scary about right now, is 2019 was a pretty good market. You've got 5.8, 6.1, 6.0, 5.3 months worth of housing available, and stuff was flying off the shelves, multiple offers all over the place. Then people chill for a minute, coronavirus, boom, down to 3.4 months. And some places it's even less. This is a nationwide number, but rates are at all-time low. Demand is at an all-time high and supply is down here at an all-time low. It's a recipe for what's going on right now, which is just bonkers real estate market. People are offering tens of thousands above asking and waiving their appraisal contingency. It's a wild world, but it's a wild year. So hopefully you enjoyed this video. If you made it this far, I appreciate you. Any questions at all? If you're in California, I can answer any mortgage related questions you have. Matt, M-A-T-T, at mattthemortgageguy.com. If you're outside of California, I'm happy to help answer all those questions. I just can't lend to you. So same email address, Matt at mattthemortgageguy.com. I'll refer you to a great broker in your state, or findamortgagebroker.com. Thanks for watching.